Hello, Professor Simpson. This is Group 7 on the sales data analysis and new product development for Heavenly Chocolates. In our group, we have Diana Alonso, Gabriela Beltran, Serena Jones, Michelle Perkins, John Rogue, and Jose Zambrero.
So Heavenly Chocolate is a chocolate manufacturer that recently launched an online website. They're looking to increase sales, and they're trying to find out if online shoppers that spend more time and view more pages also spend more money on their website. They also want to find out if, depending on the browser and the days of the week, if there's a correlation between sales. If you look, we picked 50 random customers in the last month, and their total amount spent was $3,470, with an average customer spent between $51 and $75. The average calculation was specifically $69.42, and there was an outlier of $159, which was unusual.
So the total length of time of the 50 online customers was 640 minutes on heavenlychocolates.com. That means that on average, a customer is spending approximately 12.8 minutes on the site, with a majority of the customers within the 10 to 15 minute mark, even though there's a maximum time of 32.9 minutes. The histogram above shows that Heavenly Chocolates can use their marketing and sales decisions to know that they have between 10 to 15 minutes in order to grab the customer's attention to do the most product and best site experience possible for the customer. What the formula states here is that for every minute spent on the website, there will be a $3.05 increase. And from the linear model, it shows that there is a 33.16% variance on those data points.
The most average amount of customers spent on the website per page is between 3 to 4 pages, with the actual viewed of 4.82. If we look at the chart, this is a great statistic because it shows that customers are going beyond one page and that there's a positive relationship between the dollar amount spent and the linear regression. The more time that a customer spends on the site, the more that they spent. There is a 52.35 proportion variance that accounts for all of the sales based on the pages viewed.
The formula states that for every additional minute spent on the site, there is an increase of $1.19 per page, and there is an increase of $9.30.
So even though that every browser was commonly used, the two most commonly used were Firefox and Chrome. 85% of the actual sales came from those two browsers. An interesting point is that although 2/3 of the numbers of customers came from Chrome, Firefox actually had 74% of the revenue.
So based on this table above, Friday has the biggest sales of $959.52 total spent, with Monday at $824.93 in a close second. Ironically, though, Monday has the highest average amount per customer with a total of average of $91.60, with a close follow by Friday at $87.23. Monday and Friday combined account for 51.42% of the total sales per week. Knowing what day of the week is best for sales can assist Heavenly Chocolate in increasing the sales overall.
Heavenly Chocolates is considering the production of a new white chocolate bar. Their fixed costs are $5,000 and their variable costs are $2.50. They're planning on selling the chocolates at $9 and expect to sell 1,000 boxes. In order for Heavenly Chocolates to start making profit, they have to sell a minimum of $1,500 at 1,000 boxes. they can actually increase their profits if they sell it at $10 a box, increasing their profit margin about 17%.
At 667 boxes, as we see here on the next slide, the break-even point of production created by Heavenly Chocolate at the sale of $10 is $6,667.50.
If we look at the two-way data table, we'll see that an increase in price or demand improves the margin, but the demand has the largest impact. The increase in revenue is far more significant, which demand is increased than where there is an increase in price. In order to achieve higher profitability, they should focus on improving the quantity sold rather than the price of where the boxes are sold at. And this, Professor, concludes our presentation.